This was my first target on this pullback here at 39.48. We obviously hit it. We bounced. Now we're starting to break lower. My next target is 38.45. After that, we're looking at 36.95. And the big level where I will be accumulating in a major way is this max drawdown level at 34.85. At that point, we're almost back $1,000 lower on gold. This is a pullback where we should see new all-time highs in 2026. So yes, it's going to be a pullback where it could come back as much as, another, we're trading around 3,900 and change. So we could come back another $400, $500. But at that point, I think you have to buy it because you're right. And I still think gold, we could be looking at gold in a few years at 10K. I don't think that is out of this realm.
In this insightful market update, renowned trader and technical analyst Gareth Soloway breaks down his latest outlook on gold prices and what traders should expect in the coming months. After reaching a key target around $3,948, gold experienced a bounce but is now showing signs of further weakness. According to Soloway, the next support zones to watch are $3,845 and $3,695, with a major accumulation level near $3,485. A point he describes as a max drawdown and a potential golden buying opportunity. This pullback, while significant, could set the stage for a historic breakout. From the current trading range around $3,900, gold could correct another $400 to $500 before resuming its long-term uptrend. Soloway believes this correction is not a bearish signal, but rather a necessary reset before the next bull cycle, one that could send gold to new all-time highs by 2026. In his long-term outlook, he even sees the potential for gold reaching $10,000 per ounce within a few years, driven by macroeconomic forces, inflationary pressure, and investor demand for safe haven assets. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on gold, silver, and the markets.
But I looked at the chart of gold in 1979, and it was identical to the chart that we were currently forming. Now, you might say, well, how is that even possible? That was 45 years ago. But look at this. Look at how gold behaved going into this period. So you have this, essentially, you have in 1979, this beautiful move up. Then we had this consolidation phase. In 2025, we had the move up, the consolidation phase. Then literally in 1979, we had 9 months of upside in gold. So 9 consecutive months of up. 1, 2, 3, 4, 5, 6, 7, 8, 9. And we had this big correction. Look at over here. 1, 2, 3, 4, 5, 6, 7, 8, 9. And lo and behold, we're now correcting. And so we are mimicking the 1979 to 1980 top in gold. Now, I do want to make this clear, is it is different this time. Yes, the pattern is repeating. In 1979 and 1980, Volcker was raising interest rates 18%, 15%. It was just incredible, versus now the Fed is cutting rates. All right. Also, the GDP, debt to GDP, was 30% back then. It's 130% now. And so for the thesis here is that while the pullback is going to be deeper than most people think, I actually think we hit new all-time highs in 2026. And so I think it's going to be much more shallow versus in the 1980s. We didn't actually hit new all-time highs, I think, for like 20 years on gold from that top in 1979, 1980. So I don't think the pullback will last as long, but I still think we'll retrace. And I just want to show one other thing here on this chart, is that if we look at how deep the pullback was before we kind of got our first big bounce in gold, it basically went back to essentially that major pivot high right here where we consolidated, right? And so here you can see it pulled back right there. Okay. So the idea here is the same thing could be replicating where we pull back to about 3,500 and then we start our next leg to the upside. And so anyways, at least that's my view on it, is that I'm a big long-term bull on gold. I've been holding gold for years and years and years. It's great to feel like it's finally paying out. I'm sure many people feel like that, but it doesn't mean it's immune to pullbacks. A lot of people were thinking silver would rip higher, way past this 55-ish level. But look at this chart. This is a parallel. So parallel meaning that this bottom line is perfectly parallel to this top line. This is your low in 2008. So your financial crisis low. This is your low in COVID. If you take that line, right? So let's just go back to that and say, all right, here we draw this up and we bring this to the high of the bull market in 2011, it gave us precisely our high in 2025. Now, just like with gold, I think that, you're going to get a pullback here, especially with an pseudo-industrial metal like silver. But I would start looking to buy once we get back to about the $43 level. All right, you have a level here and you have an upsloping trend line in this range here. But these are both levels where I would start to really heavily accumulate. Basically, once we get below 43, I'm buying all the way down as far as it wants to go for that next leg up. Because I still think, again, yes, it's industrial, but it's still a metal, right? So it has to be denominated in terms of dollars. And if dollars are depreciating, by default, silver should go up. And I think those are other factors where central banks are telling us what to do. They're all buying gold, right? And so while gold is reacting emotionally, so you're getting this sell-off and you'll probably have the margin calls causing more selling pressure, people taking a little bit off the table for profits, inevitably the trajectory should be much, much higher. And I still think gold, we could be looking at gold in a few years at 10K. I don't think that is out of this realm, considering recession in the US or globally. The amount of printing that would have to be done to get us out of that would be massive, and gold would be the main recipient. I mean, Bitcoin to some extent, I think, as well, but that's more of a risk on, risk off asset, right? I do see silver potentially at $100 in a few years. It's just a matter of you got to flush out the weak hands. And this goes for gold. A lot of people get very upset when you're talking about any asset that they're long pulling back. But there was a point where you saw that parabolic move in gold and silver. And that's where you start to get people that are thinking, oh, this is the easy investment, right? And for those of us that have been long-term gold holders, there's no such thing as easy in gold, right? Or silver. So, those people have to be flushed out, get the weak hands out, get it back to its hardcore level, and it'll start grinding higher again and make new all-time highs.
In this powerful market analysis, veteran trader and macro strategist Gareth Soloway compares today's gold chart to the historic 1979-1980 cycle, and the similarities are striking. Just as gold rallied for 9 straight months in 1979 before a sharp correction, the current chart is showing an almost identical pattern in 2025. While the pullback may feel intense, the setup points toward a major long-term buying opportunity, with price targets around $3,845, $3,695, and a deeper accumulation zone near $3,500. This correction could mirror past cycles before a renewed surge. Unlike the Volcker era, however, today's environment features rate cuts, 130% debt to GDP, and global monetary debasement, conditions that favor higher metal prices ahead. Soloway expects a shallower retracement this time, leading to new all-time highs in gold by 2026, with potential upside toward $10,000 in the years beyond. He also outlines a similar setup for silver, eyeing long-term targets near $100 once weak hands are flushed out. Let's get into the interview.
Gold is usually a safe haven asset. So when things get bad, people want to buy gold. But the problem is people have been buying gold and it's a larger part of their portfolio. And so when we see the stock market decline sharply or the crypto markets decline sharply, there will be some margin calls in those groups, which will then cause people to have to sell some of their gold to cover those margin calls. And I think, again, this is where leverage comes in. People have gotten way over leveraged in the stock market. In fact, I was looking at margin numbers. People are borrowing more money than they've ever borrowed before to invest in the stock market. That's great when it just goes up, but when it corrects, that creates margin calls, and that money has to be found somewhere. And again, I think this is where the case for a pullback in gold comes in. And look at the performance of the stock market, and there's been a divergence where Bitcoin has been much, much weaker than the stock market. And usually they go up together and they fall together. And the thing is you didn't see Bitcoin making new all-time highs when the S&P was making new all-time highs. But today the stock market's falling and Bitcoin's getting smoked. So it's like, it's the worst case scenario, right? Where it's not performing with the markets to the upside, but then tagging the markets when the markets drop, it drops. Now, again, one of the things to keep in mind here is that if you look back at 2017 in the bull run and 2021, interestingly enough, Bitcoin topped out 4 to 6 weeks before the stock market. So it was almost like a leading indicator. And the question is, today is the 4th of November, right? And the high on Bitcoin was basically, it looks like October 6th. So essentially a month ago. And so I wonder if Bitcoin wasn't seeing selling by bigger players that knew the market was coming. They were de-risking in Bitcoin first. and then looking to now unload into equities. That's what I would say. Now, a couple things to note here on the chart is we do have a major technical trend line coming into play around 93 to 94,000. Basically, the beginning of the bull run, which started here in October of 2023 when Bitcoin was about 26,000. You can see it continues to rise, but every time it comes back to this line, it tags it and goes back up.
As global markets wobble, the relationship between gold, silver, and Bitcoin is revealing key signals. Gold, long seen as the ultimate safe haven asset, is now facing temporary selling pressure as investors liquidate holdings to meet margin calls triggered by sharp declines in stocks and crypto. Excessive leverage in the equity markets has amplified this short-term volatility, forcing even disciplined traders to raise cash wherever possible. Despite this, the broader trend remains bullish. Gold's current correction toward the $3,500 zone could offer a once-in-a-cycle buying opportunity before the metal resumes its climb toward record highs in 2026. Silver's retracement below $43 may present a similar setup for long-term accumulation. Meanwhile, Bitcoin's recent weakness, topping out weeks before the stock market, may again prove to be a leading indicator of broader market stress. But history shows that such flushouts often precede powerful recoveries across hard assets. The message is clear. Pullbacks create opportunity. Manage leverage, stay patient, and prepare for the next leg higher in the metals and crypto markets. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on gold, silver, and the markets.